Okay. Going live in 1 minute. So good. Okay. Hey guys, welcome to another amazing OctaFX webinar. My name is Ambrose Ebuka, and we are on the second episode of the online workshop for complete beginner series. Today we're talking about the first steps in trading. But before I go ahead to tell you guys, what we have on this webinar, you can type your name and where you're watching me from in the chat box. So go ahead and type your name and where you're watching me from in the comment section below. You can also go ahead to tell me if this is your first time of watching an OctaFX webinar. All right. Okay, so let me go ahead and talk to you guys about bonuses that you can get for just watching an OctaFX webinar. The first one is 100% single-use deposit bonus per webinar series. How do you get this? You sign up or confirm your participation on the OctaFX website. You watch all the webinars from the series. You wait for an email from OctaFX confirming that your bonus is ready. You initiate a new deposit request, and you check claim the bonus for this deposit. Now this bonus expires on the 5th of May 2022, and you can also get a free traders guidebook in PDF. How do you get this? You watch all the webinars from the series, you stay active, you ask questions, you answer my questions, and you would get your PDF handbook via email once the webinar is over. We have Charles from Nigeria. Welcome, Charles. We have Bruce from South Africa. We have Samson from Nigeria. We have Clement Okoro Israel from Nigeria, and he says it's his first time. Welcome. I'm pretty sure that after the webinar today, you're going to get some extra information about the Forex market. We have Olatunji from Ibadan. Welcome, Olatunji. We have Davis from Abuja. Neil from South Africa. Barbara from South Africa. We have Yakus or Yakus. Sorry if I didn't pronounce your name correctly. But we have Yakus from Jos and Kelvin from Ghana. Now, if I keep calling the names, I'm not sure we're going to start today. But massive welcome to you guys. So let me just go ahead and tell you guys, the talking points of today's webinar. What are you going to learn today? The first thing you're going to learn is buy and sell orders. You're going to learn about margin. You're going to learn about how to calculate your equity. You're going to learn about line and candlestick charts and what a spread is. Okay, so massive welcome to you guys. The first timers, Israel from Andrew Frederick says this is his first time. Massive welcome to every one of you. All right, so the first thing we're going to look at is obviously buy and sell orders. What are buy and sell orders? Now, generally, an order is an instruction sent to your broker to open or close a transaction. It could be a buy order or a sell order, and we have some types of market order, two types actually, which is the market execution and pending orders. Now, for market execution, this is basically an order that is instantly executed at a price that your broker has provided. A market order could be a buy or a sell order, right? So a market execution order is an instant executed order. Now for the pending orders, a pending order is an order that is to be executed at a later time, at a price that you specify, your preferred price. So for example, if you're looking to buy let's say a currency pair at, let's say for example $60, and the currency pair is currently at $40, and your preferred price to buy that currency pair is at $60. You can use a pending order to place your order on that currency pair, which would activate or execute once the price has reached your preferred price. I'm going to go into detailed explanation on that in the course of this training. So for pending orders, the trade will not be active until market price gets to the specified price. So if market doesn't get to your preferred price where you want to, where you want the trade to be executed, the trade is not going to be executed. Now for a pending order, we have buy limits, we have sell limits, we have buy stop and sell stop order. I didn't say this, but in the course of this training, if you have questions, you can go ahead and ask your questions in the comment section. I would constantly check the comment section to see if you have questions and answer your questions. Okay, so like I said, we have market orders and pending orders, and a market order, or it's also called market execution because it is executed instantly, can either be a buy or a sell, right? That's for market orders. Now for pending orders, we have buy limit, buy stop, sell limit and sell stop, right? Now for the pending orders, we have two types of pending orders. Let's talk about the first one, which are the limit orders, right? Buy limit and sell limit. So for a limit order, it's basically an order that is placed to either buy below the market or sell above the market at a certain price. Now one way you can easily understand how the market works is to take your definition of whatever you learn and just apply it to what you see on the market, right? In this case, a limit order is said to be an order that is placed to either buy below the market or sell above the market at a certain price. What we mean by above the market is above the market price, right? If you look at this example right here, the blue dot indicates market price, this blue dot that you see here. And for a buy limit, it's an order that is placed below the market price in expectation that this price is going to move up or go up after your buy limit order has been activated, right? Types of limit orders, we have buy limit and sell limit. Now for a buy limit order, you're placing your order below the current market price, so if you have market price at let's say $50 and you want to place a buy limit, your buy limit order is going to be placed downwards, like from 49, 48 for example purposes. So your buy limit order is going to be placed at 49, 40, below the market price. That is if the market price is at $50, right? And for sell limits, you're placing your order above the current market price. You're placing your order above the current market price. Now I'm going to show you guys how you can actually place these orders on your OctaFX app. Let me do that real quick. Okay, so to place a buy limit pending order, all you have to do is come to your OctaFX Trading App and you click on new order. New order is right here. And now you want to change your type of order from market execution to pending order, right? Because you're placing a pending order. And once you do that, it's going to bring out an option for you to choose which of the pending orders you want to place. Now we're talking about limit orders, right? So we're going to start with buy limit. So I'm just going to choose buy limit, and then remember the definition, guys. I told you to really understand how it works, you just take the definition, apply to the market, and get an idea of how exactly it works. So for the buy limit, remember you're placing your order below the market price, right? Now how do you find market price? This is the market price right here, this line, and if you guys can see that, make it visible for you guys. Okay, so this line, so the market price is at 125.55, right? Now for a buy limit, you're placing below, so you're looking to place your buy limit order around here, which is below the market price, in expectation that market is going to get down to your preferred, price where you've placed your buy limit and continue to push upwards, right? So let's say, for example, we want to place our buy limit order at 125.26, right? 125.26. Why is that? Because it's below the current market price. So remember, type pending order buy limit. So we're using 125.26. We're placing the buy limit below, and then we just click on place. So as you can see, the buy limit order has been placed. Now remember, your pending order does not execute until market price has gone down to where you've imputed your pending order. For example, we have a pending order for buy limit at 125.26, right? So it's not going to get active. It's just going to be at zero, profit and loss zero, right? It's not going to read anything until market gets down to 125.26 and activates. Now, what does market do when it gets down? It's going to recognize the pending order, number one. Okay, yeah, this is a pending order. I've recognized it. Now, what pending order is this? Is this a sell or a buy? Oh, it's a buy. How do you make profit on a buy trade when the market moves upward, right? So it activates or executes at your preferred, buy limit order, and then you make profit when the market goes up. If the market goes against you, let's say the market goes down, you don't make profit, right? So your buy limit order, executes only when market gets to the preferred price. And it's the same thing for the sell limit, just that the sell limit is placed above the current market price, right? So we did an example for buy limit. We're going to do an example for sell limit. Okay, so for sell limits, remember, take the definition applied to the chart. So for sell limits, you're placing your sell limit order above the current market price, and remember, current market price is right here at 1.2575. Now if you're placing the sell limit, you're placing it above, which is going to be around here, any of these places, right? So let's say we want to place a sell limit order at 1.2612. Same method. You click on new order, change the type from market execution to pending order. We're placing the order at 1.2612, and then we click on, oh yeah, it changed from buy limit to sell limit. Remember guys, you always want to identify which order you're placing. So you change from buy limit to sell limit. We've done buy limits, now we're doing sell limit. So we're going to click on place. What just happened? The market has, or your broker has acknowledged your order. They've placed the order for you at your preferred price. Now the order is not going to start reading, or it's not going to be activated until market price goes up to touch your preferred price, and then the order, your sell limit order, gets activated. Price or market is just going to recognize that, oh, there's a pending order here. What order is this? It's a sell. Okay, how do you make profit on the sell? When the market goes down, right? And when the market sells, you make profit. So that is how the buy limit and the sell limit works. Now we have another type of pending order, which is the stop orders. The stop orders. Now a stop order is an order placed to either buy above the market or sell below the market at a certain price. Now remember, for limit orders, for a buy, you're placing your limit order below the market price. But for a buy stop, or for a stop order, if you're placing a buy, you're placing your buy above the market price. Now a stop order is an order to buy or sell once market reaches the stop price. Two types of stop orders. We have the buy stop and we have the sell stop. Now for a buy stop, somebody says, is it possible to leave the buy limit until it rises again, even if it goes below your buy limit. Okay, so I don't think you got the explanation, but once market gets to your preferred price meaning your pending order, right? Once it gets there, it executes your trade. Now for the buy limit which you're talking about right now, if the market gets to your preferred price for that buy limit, it executes the trade automatically. It's like the trade has been executed. The only difference is it's just like it's going to act like a normal instant execution. The only difference is that it was executed in or at your preferred price. Okay, so that's for the buy limit. Now back to buy stop. For a buy stop, you're placing your order above the market price, and for a sell stop, you're placing your order below the market price. Now for a buy stop, you're placing your order above the market price in anticipation that the market is going to continue, going upwards once your buy stop has been activated. I'm also going to show you guys how to do that in your OctaFX app. Okay. Yeah, so we talked about sell limit. I think I'll just take it out so we can. Okay, so now we're talking about buy stop and sell stop. I'm going to start with buy stop. The same way to place this pending order. So you go to new order right here, click on new order, change your type from market execution to pending order, and then you change your type of pending order to buy stop if you're placing a buy stop. So we're placing a buy stop, so we're going to use buy stop. Now remember, you're placing your buy stop above the current market price. The current market price is at 1.2570, right? Market is quite volatile at the moment, but yeah, 1.2570 above the market price is going to be somewhere. It's going to be all these places above, right? And remember, you're placing your buy stop in anticipation that market is going to go up, activate at your pending order, and continue to move upwards, right? So let's say we want to place a buy stop at 1.2590, right? Which is here. So 1.2590. Click on place. So what has happened? The broker has acknowledged your pending order, placed your order for you. So basically your order is going to start reading if the market goes up to this place and activates your order, right? So you're placing, what's just going to happen is the market is going to recognize your order, and then, oh, okay, what pending order is this? Is it a buy? Is it a sell? Obviously a buy stop. So once it's activated, automatically it goes as a buy trade. Remember, the difference between your pending order and instant order is that for pending orders, it's going to be activated at your preferred price. Okay, all right, so let's talk about sell stop. Buy stop is placed above the market price. Sell stop is placed below the market price. Okay, Thompson says, in a situation that the market price did not get back to your preferred price that very day, will the swipe fee be charged on the order if I leave it to the next day? No, your order doesn't get activated until market has gone to that point, right? And swap fees are charged on executed orders. Okay, so yeah, so for sell stop, the same method, new order, click on pending order, you want to change the type, and then you want to change it to sell stop because you're placing a sell stop order. If you're placing a buy stop, you want to use buy stop, right? Now for sell stop, you're placing it below the market price in anticipation that market gets to the price and continues to go down. Okay, so sell stop order is going to be placed around these zones. So let's say we want to place it at 1.255.7. 1.2557. So what happened? Your broker has acknowledged your pending order. They've placed the order for you, and now your order is only going to be activated when market gets to this point. I know you're seeing the trade or the pending order showing green right now. What it means is it's OctaFX is telling you that your price is getting close to your preferred sell stop order. Okay, so if market goes up to this point, then the buy stop would change to green. OctaFX will tell you that price is getting close to your buy stop order. Okay, guys, please don't forget to always place your trades, buy stop or sell stop, buy limit or sell limit. Place your trades with a stop loss and a take profit. Okay, you don't just want to place your trades and let your trades just run like that. That's a lot of risk exposure to your trading account. Okay, and another thing that I wanted to tell you guys about buy stop and sell stop is, in order to modify this, you can just drag it down. Okay, so if you change your mind, probably because you've done an analysis and you're like, oh, okay, let me just take this down to 20 pips, 30 pips, you can just drag to modify. Okay, so that's on pending orders. If you're using the OctaFX trading application, then I'll show you guys how you can place your pending order. Davis is saying, what is the main difference between limit and stop orders? I explained that, but I'll just give you one quick answer. So for limit orders, you're placing, for a buy limit order, you're placing below the market price, anticipating that market is going to get down to the price and activate, okay, and continue to shoot upwards, right? So if market goes upwards, or if market gets down to your preferred if market gets down to your preferred buy limit order and activates, then you're expecting the market to move up, right? Because it's going to indicate that, oh, this is a buy trade. Now for stop orders, you're placing, for a buy stop, you're placing your buy order above the market price. So you see, for buy limit below, for buy stop above, the market is going to, if the market gets there, it activates and recognizes the trade, depending on order you place, if it's a buy or it's a sell, and it goes in the direction. Yeah, so that's like a quick difference. The sell stop and sell limit is the opposite. Okay, so if you're using the OctaFX Trading App, then all you have to do is you open your app, you want to click on trade right there, and then it's going to take you to where you can see multiple instruments that you can trade. And in this case, let's say I want to trade USD JPY, right, which is the second instrument right here. So I click on USD JPY, and it's going to take me to the USD JPY chart, and I want to click on pending order. This is if you're using the OctaFX Trading App. So you want to click on pending orders, and it's going to take you to a new page, where you're going to put your entry price if you're placing a sell pending order, or if you're placing a buy pending order, right? So OctaFX also gives you this illustration to tell you, oh, look, this is where price is, and your entry price is currently above the market price. So this is a sell limit. If I change this to buy and my entry price is below, OctaFX also tell me, look, this is a buy limit. Let's say, for example, I don't want to place a sell limit, I want to place a sell stop, right? And I want to place a sell stop. Obviously, a sell stop I'm placing below the market price, because I'm expecting price to activate or execute at my preferred price and continue to go down, right? So let's say I want to place a sell stop at 125.0. I change this entry price figure to 125.0. Now what happens? You see, OctaFX has told me that, oh, look, it's not a sell limit anymore. Your entry price is below the market price, and now that is a sell stop. Okay, so you go ahead to click on limits, input your stop loss and your take profit points, and you click on place order. So that's how you place a pending order on your OctaFX trading application. Now we're going to talk about margin. What is margin? Margin is a good faith deposit that is needed to open a position and keep it open as determined in the contract specifications for each instrument. Someone just asked something about, pending orders. Why do we need to use pending orders? Now, the advantage of pending orders is it's time flexible. That's number one. If I'm placing a pending order, I don't really need to look at my trading app all the time, stay constantly focusing on my trading app to see. I can just place at my preferred price, go ahead to do what I have for the rest of the day. If market gets to my preferred price, the trade activates, and if the market doesn't get there, the trade doesn't activate, and market still moves, right? So it's time for, it lets you do other stuff. You don't necessarily have to always look at the market to see if market has gotten to your preferred price, so you can place an instant execution, and that's actually a good advantage. Let's say, for example, I want to watch a football match, or I want to go on a date or something, and then I take my phone to no. So that's an advantage of the pending order. It's quite time flexible. It helps you focus on some other things while you still place your trade at your preferred price. Okay, so what is margin? Like I said, margin is basically excuse me, margin is simply a portion of your funds that your broker has set aside from your account balance to keep your trade open and ensure that you can cover the potential or negative effect of that trade. Now, once the trade is closed, the margin is freed or released back into your account and can now be used to open new trades. Now, OctaFX has this margin calculator that you can use to know, okay, what is the required margin for this trade that I want to place. I'm going to show you guys quickly how you can use that. So let's say we're looking at USD JPY right now. So let's say I want to place a buy trade on USD JPY, right? And done some analysis, and I want to use a 0.10 lot size, a mini lot size, right? I go to the OctaFX calculator. So if you just go to the OctaFX website, you just click on analysis and education. You come down to trading calculator. So in this example, I used USD JPY, right? USD JPY. So we want to change to USD JPY. The leverage is 1 to 500. And remember, the lot size I said I was going to use was 0.10, a mini lot size, right? So if I click on calculate, OctaFX will just show me the required margin, the good faith deposit required to keep this trade run. So this is the required margin is $20, right? So if I just go ahead to say, let me place a trade. This is a demo account actually, guys. I'm not telling you guys to place a trade right now. So let's say I'm using 8.10 lot size, for example. So you can, if you look right here, you're going to see that the margin is $20, just like it said here, right? It's also going to show you your value per pip. Okay, so if you look here, you're going to see that the margin is $20. So you can take advantage of the OctaFX margin calculator to know the required margin for your trades. Okay, so let's talk about margin level. What is margin level? So margin level is a relation between your account's current equity and required margin. So it's calculated by equity divided by the required margin multiplied by 100. Okay, so your margin level basically just indicates how healthy your trading account is. The higher your margin level, the healthier your account. If your margin level is low, it's going to have a negative impact on your account. So it's very important that you pay attention to your margin level. The next thing we're going to look at is free margin. Free margin. Free margin denotes the funds in the client's accounts which may be used to open a position and are available for withdrawal. So if I go back to the example trade that I placed, you're going to see that the free margin is $4,979.52. it's changing because there is a running trade, right? So the free margin is the amount I have left to open new trades. Okay, so with OctaFX, your deposit bonus is part of free margin until your volume requirements are met. All right, the next one we're going to look at is margin call. Remember, guys, your free margin is calculated as equity minus required margin, so you get your free margin. So let's talk about margin call. So margin call is a point at which additional funds may be required to maintain open positions should the market go against the trader. So margin call is basically, a notification which tells you that you need to deposit more money in your trading account or close negative positions in order to free up more margin. Okay, so that's for margin call. Basically, when your trading account gets to a certain percentage, your broker would notify you and tell you that, look, this is a point where you're required to add additional funds to free up more margin. Okay, so we're going to talk about equity. Remember, guys, if you have questions, go ahead and type your questions in the chat or the comment section. I'll constantly check to see if you have questions. All right, let's talk about equity. Now, a lot of traders find balance and equity confusing, but I'm going to explain that to you guys right now so you can understand the difference between balance and equity. Okay, so equity is the amount of funds on an account that includes balance and floating profit and loss. When there are no open positions on the account, equity is equal to balance. Remember, all you have to do to really understand, definitions, to really understand things in the Forex markets is to take the definition and apply it to your app, your chart, whatever you have, whatever you're trading on. So remember, equity is the amount of funds on your trading account that includes balance and floating profit and loss. When there are no open positions on the account, your equity is equal to balance. So I'm going to go to the example trade I just placed. And right now, our equity is at 4,999.88 cents. How do you calculate your equity? Your equity is equal to balance plus profit or balance minus loss. Now, this is the difference between your equity and your balance. The equity is giving us this figure because our trade is at minus 1.12 cents or minus 1.4 cents. So basically, to get this equity, we just calculate the balance minus what we have here, and then it gives us our equity. If this trade was in a profit of like $2, then our equity is going to be balance plus the $2 profit, and our equity is going to be $5,002. Okay, so that's how you calculate your equity. Equity is equal to balance plus profit or balance minus loss. If you don't have any open positions, then your equity is going to be the same as your balance. All right. Okay, so let's talk about line and candlestick charts. Line and candlestick charts. Now, a line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see the general price movement of a currency pair over a period of time. Let me show you guys what a line chart looks like. Boom. So this is what a line chart looks like. Now, the line chart is actually simple to follow, but the line chart may not provide you, like as a trader, much detail about the price behavior within the period. All you know is that price closed at this, price closed at this. You don't exactly have an idea of what exactly happened. Okay, I mean, it's quite smooth, yes, but it doesn't show you in details what exactly happened, which is why I'm going to talk about the candlestick chart. So a candlestick chart is a single bar which represents the price movement of a specific currency for a period of time, or a specific currency pair for a period of time. The information it displays includes the high, the low, and the close for that time period. Let me show you guys what each candlestick. I mean, you obviously have an idea of what it looks like. So this is what it looks like, a candlestick. We also have a bar chart. Okay, a bar chart looks like this. Where a candlestick chart is actually popularly used by traders. Now each chart has its own advantages and disadvantages. You can choose any type or use multiple charts for your technical analysis. Okay, the thing is that the data may be the same to create the chart, but the way that it's going to be presented and interpreted may not be the same. Okay, so this is a candlestick chart. This is what it looks like. We're on USD/JPY, and remember, a candlestick chart shows you the open, the high, and the close for that time period. We have a few advantages of the candlestick charts, which is number one, candlesticks are easy to interpret and are good for beginners to start figuring out chart analysis. Right? Remember, they give you more detail about what happened. The candlesticks are easy to use. Your eyes adapt almost immediately to the information in the bar notation. Candlestick and candlestick patterns have names which would help you to remember what the patterns mean. I mean, if you're learning about candlesticks, you come across shooting star, morning star, doji, all these funny names that just quickly comes to your mind when you want to remember a candlestick chart pattern. And candlesticks are good at identifying market turning points, trend reversals from an uptrend to a downtrend, or trend reversals from a downtrend to an uptrend. Now, candlestick patterns appear in different forms, but majorly a thick body and a small wick, which we have here, a long wick and a small body, and a long wick but obviously no body, or the same amount of body. Basically, this means that the price opened and closed at the same price or almost the same price. So for the first one, remember, the candlestick shows you the open, the high, the low, and the close of each candlestick. Now you're going to see something like this on a candlestick. If you use candlestick, you're going to see all these candlesticks right here. What this means is that, first of all, we are on a 30 minutes time frame, right? So what this means is that each candlestick here opened and closed within 30 minutes. So if I decide to go down to 15 minutes or the 15 minutes time frame, what this means is that each candlestick here opened and closed within 15 minutes. If I decide to try the 4-hour time frame, it's going to, the display changes because it's now showing me the candlesticks, the opening and closing of these candlesticks within 4 hours. So if you change the time frame, the candlestick changes and gives you the results based on your time frame, right? So candlesticks can either be bullish or bearish, and then we also have an indecision candlestick, which is also called the doji candlestick. So candlestick can either be bullish or bearish, and for a bullish candlestick, it closes above the opening price, right? For a candlestick to be bullish, then it has to close above the opening price. For a candlestick to be bearish, it has to close below the opening price, right? So for this bullish candlestick, you see that the opening price is right here and the closing price is above, right? So it opened and went up. When you hear bullish bulls, your mind goes to the upward direction. Same thing goes for the bearish and the bears. Opens above and closes below, right? And then we also have these candlesticks with long wicks that indicates a rejection. right? I mean, it's red because it's a bearish candlestick because it closed below the opening price. Yes, but we also need to, recognize the long wick. This long wick is like a trace. It's spelled as WICK, right? Let me see if I can type that fast. Okay, so this is how we spell the wick. This is what it's spelled as, WICK. Okay, so basically what it does is put that a little bit. Yeah. Okay, so for this week, it shows us that at some point within the opening and closing of this candlestick, price was at this point, but it's obviously not here anymore because it was rejected by the bears, right? It was rejected. The buyers were able to push this candlestick open here. Buyers were able to take it upwards, but they could not sustain that pressure. So the sellers took over, the bears took over and brought it down, which created this trace, this wick, and then it closed below the opening price to form a bearish candlestick. Same thing goes for this one that closes, above the opening point. It shows you that price opened at this point. The bears were able to take it down. They couldn't sustain the selling pressure. The buyers took over, took the trade, took the candlestick upwards, or the market price upwards, to close above the opening point, which is why it's a bullish candlestick. And for the doji candlestick, which is also known as an indecision candlestick, it just shows you that the market opened and closed at the same or almost the same price. I mean, neither the buyers or the sellers were able to take control of this candlestick. So we're just going to read a candlestick together in 30 seconds. Okay, so let's take note of the next candlestick that's going to form right now. All right, so a new candlestick has formed. If you can see it, it's currently bearish. It's currently a bearish candlestick because it is below the opening price, right? And you can see that the sellers or the bears are taking control. They're sustaining, or they've managed to keep this price below the opening price of this candlestick. And it's going to close as a bearish candlestick because the sellers closed below the opening price. The same thing for this one. It's going below the opening price. It just formed right now, but it's below the opening price, which is why it is a bearish candlestick. If the buyers are able to push this candlestick upwards to this point, then it's going to turn to a bullish candlestick. And if it closes above this point, then it's going to be a bullish candlestick. But obviously, I don't think it can do that. It's going to close bearish. Okay, so yeah, close bearish. Okay, so that is how to identify the opening point, the high, the low, and the close of a candlestick. Right now we're going to look at spread. Okay, EO is asking what causes the rejections represented by the wicks. It's the buyers and the sellers, right? We have buyers and sellers in the market. So if the sellers are, if the momentum of the sellers are not much, the pressure of the sellers are not much, and the buyers take over, then the candlestick goes in the direction of the buyers. But the candlestick is going to leave that wick as a trace to tell you that at some point in the opening and closing price of this candlestick, the price was at this point. Okay. Yeah, so let's talk about spread. What is spread? Spread is the definition, the difference rather. Spread is the difference between the lowest ask price and the highest bid price, which is measured in pips. So spread is like the difference between the ask price and the bid price. So if you go to, let me take this to the yeah, so if you look at these two prices, the one above is the ask price, the one below is the bid price, or the red one, which is the ask price and the bid price. You're going to see that there is a small space between them, right? You're going to see a small space between them. That space is called the spread. You can also identify your spread at the market watch section of your OctaFX MT4 app. How you can do that is you go to the market watch. Let's say initially it's going to look like this. So you go to your market watch, you right click, and then you click on spread. So you just drag this a little bit to the right so that you can visibly see your spread. Okay, so this is USD/JPY that we're looking at right now, and the spread is currently 1.2 pips, quite tight, 1.2 pips. Okay, so the spread is basically the difference between the ask and bid price. If you go to the bank or the exchange office, the price that they would want to sell a currency to you and the price that they would want to buy a currency to you, or buy a currency from you, would not be the same. So the difference between the ask price and the bid price is the spread. And the bid price is always lower than the ask price. It's important that you note that the bid price is always lower than the ask price. The bid price is the one below, the ask price is the one above. How do you get your spread? You basically subtract the ask price from the bid price. Now, currency pairs, just like you have here, there are a lot of currency pairs, and the spread of these currency pairs, are not the same. But the more liquid a currency pair is, the tighter the spread. Okay? All right. Yeah, so I'm just going to go ahead and take your questions right now. If you have questions, you can type your questions in the comment section. I'm checking the comment section to see if you guys have questions, and I'll take a few questions from you guys. Okay, someone is asking how do you place your stop loss and take profits? So remember how you went to place your pending order, right? I think he's asking for a pending order, because for a pending order you just place your pending order, and your stop loss and take profit options are right there. So remember, you're going to new order, you click on new order, and when you click on the type of order, you change it to pending orders. Choose if you're placing a buy limit or a sell limit order, and then you can put your stop loss here and your take profit here before you click on place. Okay, so you put your stop loss here, your take profit here before you click on place. Okay, James is asking, how does spread affect our trade? Now, if you place a trade, you would have to beat the spread first before you can be in profit, right? So if you place a trade, that's why most times, every time actually, when you place a trade, you're automatically going to be in a minor loss, because that's the spread, that's the difference, right? For a buy trade, which is obviously executed at an ask price or at the ask price, your bid price has to go above your buying price. Yeah, so if I place a buy trade at, let's say market is at 1-2, let me just do that again, guys. This is a demo account, and I'm just doing this for example purposes, so don't go buy this market on your account, on your real account. So let's say I place a buy right now. Boom, you're going to see that it's currently at 10 cents. It's currently at minus 10 cents, right? Now the bid price has to go above the ask price, which is where I placed, or above this price, before I can be in profit. So that's how the spread affect your trading. Okay, so since you guys have asked questions, it's time for you guys to answer my own questions. Okay, let's do a quick brain test. So the first question I have for you guys is, for a buy stop order, the trade is placed below or above the market price. For a buy stop order. Let me know the answer in the comment section. For a buy stop order, is your trade placed below or above the market price? Okay, Naomi says above. Chris Michael says above. Victor says above. Chima James says above the market price. You guys are absolutely correct with that answer. Of course, for a buy stop order, you're placing your order above the market price, you know, in anticipation that the market price would get to your preferred pending order, which in this case is a buy stop order, activates and continues to move upwards. The second question is, if you don't, I just saw someone that said below. No, for a buy stop order, it's placed above. So I hope you got the correction. Second question is, if you don't have an open position, equity equals balance, true or false? If you don't have an open position, equity equals balance, true or false? So what I mean by open position is, if you don't have a trade running, if you don't have an open trade, equity equals balance, true or false? Chima James says true. Naomi says yes. I actually don't know if you're saying yes to true or yes to false. Mustafa. Oh, okay. Naomi says true. That yeah. Happy says true. Wow, okay, you guys are correct. If you said true to the second question, you are correct. The third question is, what is the difference between the ask price and the bid price? So what is the difference between the ask price and the bid price? Dave says true. Is true. Yeah, second question, if you said true, you're correct. If you don't have, you know, a trade running, equity is going to be equal to balance. So what's the difference between your ask and your bid price? Okay, Chima James says the spread. Victor O'Hare says the spread. Happy Obuna says the spread. You guys are correct. The difference between the ask and the bid price is the spread. Yeah, correct. Spread. Okay, guys. So that's it on the first steps in trading. Here's what we have for the next webinar. We're going to talk about predicting the market. We're going to look at the orders opened and closed by market price. We're going to talk about the 4 most important types of news or events that happen in the economic calendar, which is NFP, CPI, GDP, and Fed. We're going to explain that in detail in the next webinar. We're going to talk about take profit and stop loss and why you need it. And we're also going to talk about fundamental and technical analysis. Okay, so thank you for joining our online workshop, guys. Please fill out the form in the comment section to get a bonus. And don't forget to subscribe to the OctaFX YouTube channel so you don't miss out on the next episodes. I'll see you guys in the next webinar.